I know a lot of people, even people much smarter than me, they've been talking about silver, the value there. We're getting much closer to that point where it's really going to rip and roar. If we exclude the breakout of commodity prices in 1971, 72, if we exclude that, then silver breaking above 50 will be the biggest breakout of all time.
This is Kaiser Johnson with Liberty and Finance. With premiums on US 90% silver constitutional coinage at multi-year lows, this may be an ideal time to swap silver bars or rounds for 90% silver and gain all the benefits of US mint lineage, legal tender status, non-reportability, and fractional utility. So right now we're running a special where we will swap any of your silver bars or rounds for 90% constitutional silver at a minimal premium difference. Call us for details.
Welcome back to Liberty and Finance. We're glad to have a first-time guest today. Jordan Roy-Byrne is a chartered market technician. He also has a master's in financial technical analysis. He's the author of the 2025 book, Gold and Silver, The Greatest Gold Bull Market Has Begun. He's also the editor and publisher of the Daily Gold, a newsletter which emphasizes market timing, stock selection for precious metals investors. And Jordan, thank you for joining us this first time on Liberty and Finance.
Well, thank you so much for having me, and thank you for the kind introduction. It's a pleasure to be on with you.
I'm want to let everybody know that we're recording this on Friday, March 14th, 2025. In your book, Gold and Silver, The Greatest Bull Market Has Begun, you present a compelling case for why gold and silver are entering a once-in-a-lifetime investment cycle, is the way you put it. Using your technical analysis and your historical trends, macroeconomic indicators, you lay out a precious metals are set for explosive growth and what investors need to know right now. And because of your chartered market technician and your master's credentials in financial technical analysis, you're uniquely positioned to analyze price action, market cycles, and key technical breakouts that traditional analysts may miss. So we wanted to talk to you about diving into your book for the benefit of our viewers and subscribers. You explaining in there how gold's confirmed breakout, why a new bull secular market is unfolding. What do you see that in your view confirms a breakout and why you say a new secular bull market is unfolding?
Well, there's a couple things. And this is really fortuitous timing that we're doing this right now. I mean, because we're seeing, which I'll get to, we're seeing gold is now breaking out against my 60-40 portfolio indicator. Gold is also breaking out against the stock market, the S&P 500. If you look at that chart, it's coming out of a 4-year base. So we have a confirmed daily breakout. Now, as of today, we have a confirmed weekly breakout. We still don't have a monthly breakout, but I think we're probably going to get that monthly breakout by the end of the month. And so when you look historically, take a 50,000-foot view, typically gold and hard assets, they alternate between secular bears and bulls with the stock market. So when the stock market is in a bull, gold is usually in a bear and vice versa. I mean, now, if you go back to the 1940s, there was a bit of overlap. There was a bit of overlap in the 1960s, and we have seen some overlap in the last 5 or 6 years or so. So that's not uncommon, but for the most part, gold and hard assets, they do best when the secular bull in the stock market ends. And so that has technically, that's not ended yet. Maybe the peak that the stock market put in a couple months ago or a month ago, maybe that's the end of it. I don't know. Maybe it has one more run to a new high in the next year or so. Like maybe that ends up being the peak. So the stock market rolling over and falling below its 40-month moving average, that's one of my indicators that confirms when the stock market is in a secular bear. Now, the problem with that is that usually happens a year after the market peaks. So it's going to take some time for that indicator to be ticked. But we already have gold breaking out of a 13-year cup and handle, which it did last year. And so that was really significant by itself. Now, even more important, as I said just a moment ago, we are seeing gold break out against the stock market and my 60-40 portfolio indicator. And so I have historical data. I compiled it going back 100 years or so. And 60% of that basket is the total return for stocks. 40% is the total return for bonds. And that chart gold against the 60-40 has been trending higher in favor of gold, but you can look at the last 10 years and you see, okay, there's a base here, and that hasn't broken out yet. But as we are speaking, again, in the last week or two, gold is now breaking out against that, that chart, that indicator. It's clearly broken out on a daily and weekly basis. And so in layman's terms, what that tells us is money or capital is now moving out of conventional assets, stocks and bonds, at a more rapid pace in favor of gold. It's going into gold. Because if we think about the last, 8 or 9 years or 5 or 6 years, yes, the price of gold's gone up, the price of silver's gone up, but it hasn't felt like a real bull market. And that's because the stock market has still been in a secular bull. So people have still been buying stocks. And up until 2022, they were still buying bonds. So gold has been crushing bonds in the last couple of years, but it hasn't outperformed stocks yet. And that's why that 60-40, that gold against the 60-40 had not broken out yet. I mean, it was being held back by the strength in stocks. But again, it's really fortuitous that we're talking right now because we don't have to talk in hypotheticals. I mean, the interviews I was doing months ago and a year or two ago, it's like, well, if this and, waiting for gold, once it does this and it breaks out. And, I was talking about this for 2, 3, 4, 5 years ago, and people in the comments, they were saying, oh yeah, whatever, I've been hearing this forever. He keeps saying the same thing. So it's so nice to be doing an interview right when it's actually happening. And so again, in layman's terms, that just means this is the start of capital moving out of conventional assets and mostly stocks at this point, because it's already happened in bonds for a couple of years. So capital is moving out of conventional assets and it's moving into gold. And this is something that's going to last at least for a decade. So this is a 50,000 foot view. And the more capital that comes into precious metals, that is going to spill over more so into the gold stocks and especially silver. So you can hear the excitement in my voice because this is so critical and it's so exciting for precious metals, what is happening and basically what is being confirmed in the last week or two. So again, I don't want to belabor the point, but it's just excellent timing for what we're talking about.
Yeah, I used to have a very technical career, and part of it was the difference between weather forecasting and nowcasting. It's always very confirming when what you have predicted is actually happening as you speak. You've talked now and you talk in your book about the relationship between gold, bonds, and stock market cycles. Are there any further clarifications you want to make about that to whet our audience's appetite for what they'll find in your book about that?
No, it's an excellent question. So I'll just repeat what I already said, which is you get alternations between the stock market and gold. And again, we've seen an overlap the last 5, 7, 8 years or so. And there was an overlap in the 1960s where we know that we went off the gold standard in 1971, but before then, gold stocks functioned as gold essentially. And so if you look at the performance of gold stocks, they had this massive breakout in 1964, and that was 4 years before the S&P 500 made its secular top. Now, of course, the Dow made its secular peak in 1966. So that's really, again, gold stocks functioned as gold before 1971. And so, again, I mean, there's a lot of, there's periods of overlap, the 40s, the 60s in the last several years. But that aside, typically when the stock market makes its secular peak, that's when commodities and hard assets really accelerate and trend higher. And so that happened, that happened in 1968. So even though gold was fixed and it had a great run for 9 or 10 years, the gold stocks started moving in the early to mid 60s. So it was really a long bull market for precious metals. And I think that's similar to what we're going to see now in that, you can say, well, did it start in 2016 or 2018 for gold? Eventually, when this ends well into the next decade, maybe at the end of it, maybe in the middle, like we're going to look back and say, oh, that lasted a really long time. So yeah, there is a distinction between gold and the secular trend in the stock market. But even though there have been overlaps, it's important to know that when the stock market makes that secular peak and it's confirmed, gold and other hard assets will perform fabulously well. Now, bonds are it's a great question about bonds because they're different. You know, their long-term cycles tend to be their cycles tend to be longer, much longer than stocks, and we've seen that in that the last bull for bonds was from 1982 to 2020, and I use my secular indicator is I use an 80-month moving average for the total return for bonds, or the total real return. I can't quite remember. But so seeing this 80-month moving average in the chart, like you can see that broke in 1965, and it also broke in 2020. And it's clear looking at, you know, over a century of data that's the best indicator to define the secular trend in bonds. But that being said, there have been some periods where bonds, so they alternate, like they can be in a secular bull right alongside gold at the same time. And examples of that are the 1930s. Again, price of gold was fixed, but if you look at the gold stocks, they performed fabulously well from 29 to 37. So that was a period where you made money in bonds and stocks. And also the 2000 to 2011 bull in precious metals is also a secular bull in bonds. So bonds can go both ways with gold. But what we are seeing with respect to bonds is really significant because in the last 100 years, up until COVID, 1920 to 2020, the only period bonds were in a secular bear was 1965 to 1982. So there's not a lot of history with respect to bonds in secular bears. Again, in that 100-year period, there was only 17 years where the trend was down for long-term bond prices, and the trend was up for higher rates. So, and we know that during that period, of course, you know, I mentioned the gold stocks performed fabulously well, and then eventually commodities in the 70s, you know, they went much higher. They went crazy, and so the 60s and the 70s is the best comparison for what we're going into, because that was a point when stocks and bonds were both in secular bears. So the two competitors to gold and hard assets they were in secular bears at the same time. So that's the only other time that happened. Again, if you look at the 1930s and the 2000s, secular bull in precious metals, but also a secular bull in bonds. So now, you know, once this secular bull in the stock market ends, you're going to have a secular bear in both stocks and bonds. So that's even more powerful for gold and hard assets, because so you don't just have capital from bonds moving into gold, which we've seen the last few years. Now you're going to have capital from stocks moving into gold. So that's what's going to make this bull market more similar to the 70s than during the other periods, which was way more explosive than the other periods.
During the period you mentioned when bonds were in a bear market, you said it was time of rising interest rates. Now we've been in a falling interest rate regime for 40 years, and suddenly pivoting into a rising interest rates. There's argument among others that no matter what the Fed might do in terms of setting short-term overnight rates, that the market will determine what risk foreign holders of bonds and others are willing to bear in terms of demanding higher returns in a higher volatility or higher risk environment for bonds. Do you foresee that that's one of the reasons that capital will tend to fly from bonds into real things like gold and commodities in a potentially rising interest rate environment of increased risk?
Yes, and also we may get to a point, and maybe it's not that far off, but you know, we all know about Doge, and they're trying to cut spending, even though it's really, you know, they're not having a big impact, because you really would have to cut things like defense and entitlements. I mean, that's most of the spending, as is interest on the debt, which I talk about in my book. I mean, that's picked up and accelerated in the last 2 or 3 years, just a significant acceleration there. And so the only way to get our debt under control at some point in the next few years, we might have to do yield curve control, where they just buy long-term bonds and they keep the interest rate on the long-term bonds at, I don't know, 4% or 5% or whatever. But that of course will, you'll get even more selling of bonds by foreigners and foreign governments and central banks and sovereign wealth funds and, you know, all those people with just really huge amounts of money, huge amounts of capital. And so I mean that's what I foresee, and that's and this is not my this is not my expertise, but at some point maybe will the Fed and the Fed just have to buy all the bonds like the Bank of Japan did. I mean, I think we're just, because if you look at the numbers, look at the way interest on the debt is accelerating. I think that's what it's coming to at some point, where they'll have to fix the price of long-term bonds for a certain period. And we did that from 42 to 51, or maybe it was 1944 to 51, where basically they did yield curve control, where they set I think it was the 10-year at, I think it was 2.5%, something like that. So I think if you just look at the math, like, it's unavoidable. We'll have to see a repeat of something like that. So I don't know, maybe if people still hold bonds on paper, you'll be getting your interest, but you can see crazy inflation, or not even crazy inflation, but just the levels that we saw in the 1940s, where from 42 to 51, it was maybe from that period, it averaged like 6%, which doesn't sound like a lot, but if you average 6% a year for 8 or 10 years, that's really adding up fast.
One of the criticisms that you just described that has been levied by other analysts against the cheerleading about the accomplishments that Doge may or may not have been making so far is that a lot of the egregious, wasteful programs that they're saying, okay, forget it, just cancel this, cancel this, cancel this, those are stopping, maybe one-time savings, whereas these military spending or interest on the debt, that kind of thing, just keep coming back, quarter after quarter, year after year. So it remains to be seen how much of that differential is going to emerge between one-time spending cuts versus recurring expenses. You mentioned in your book about how silver is positioned to outperform gold coming ahead. Our viewers and subscribers have been watching that closely, and I'd like to get your thoughts on what they should look for going ahead for silver in your view.
For silver, if we're looking at long-term charts, monthly and quarterly charts, the $35, $37 levels in silver, that is very significant resistance. And so with respect to when silver will outperform gold, I tend to think, from what I've been looking at, I think when it gets to 40, or it kind of makes that move to 50, that I think that could be when it starts to outperform in earnest. But maybe I mean, I don't have the ratio handy, but maybe when it bottomed, if you're doing it from silver divided by gold, maybe when the ratio bottomed a couple weeks ago, perhaps that's going to mark a real significant bottom. But on the other side, if we're likely to have a recession, and so there could be some point during the recession where silver sells off a lot relative to gold, maybe from a much higher level than what we're at now. Like, I don't know, maybe silver runs to 50 and then the recession decline, it comes back to 37 or 38, like something like that could happen. But generally, if I'm going back, the way I'm looking at silver, okay, if it can get above 37, 38, it has very limited resistance from there up until 50. And so that's, I think, when you can see bigger moves. And if silver's not outperforming gold, that's probably the point when you'll start to see it outperform gold to a higher degree. And obviously when it breaks 50, I mean, it's at that point, it's going to crush gold. And I looked at historical breakouts, like in the mid 2000s, copper broke out of like a 28-year base. Oil broke out of, I think it was a 24 or 25-year base. And after those breakouts, I mean, they had huge moves in a short amount of time. So that's what's exciting about silver, is when it moves above 50, I mean, this thing is going to fly to 100. I mean, it could happen in like a year or 15 months. So that will be really, really explosive. That's why silver is setting up so beautifully, because it has this monstrous base going back 45 years or 46 years at this point. And I mean, we saw what happened with gold broke out of a 13-year base. So it was 2,100 a year ago, and we're ticking 3,000 today. That's almost a 50% move in a little over a year. So again, and you look at the other commodities, what copper and oil did, breaking out of their bases. This is an even bigger and longer base for silver. And so basically, if we exclude the breakout of commodity prices in 1971, 72, if we exclude that, then silver breaking above 50 will be the biggest breakout of all time. So this will be in technical analysis textbooks in 10, 20, and 30 years. They'll be talking about gold breaking out of its cup and handle, and silver breaking out of just this half-century long massive base. So yes, silver will get really exciting, but you're going to have a lot of volatility there. Like it's not going to go to 50 to 100 in a straight line. I know a lot of people, even people much smarter than me, they've been talking about silver, the value there. We're getting much closer to that point where it's really going to rip and roar. And so what people should watch for, look at 35, look at $37, look at the monthly and quarterly closes. So we got a couple weeks left, and then not only do we get to do monthly close, we get to do quarterly close. So people should, again, watch the monthly and quarterly closes, $35 and $37. Those are the key levels. If we see silver pulling away from 37 and 38 bucks, that's a sign that it's starting to rev its engine, and it's going to be able to keep moving because there's such limited resistance from 38 to 50.
Turning the page, you also talk in your book about de-dollarization and macroeconomic shifts that are fueling demand for precious metals. We've focused quite a bit on our channel, and some of our guests speak quite a bit about de-dollarization. Can you give us the view of what you're looking at in that arena?
Yeah, I can talk a little bit about that. It's not my expertise, but I know how important it is, which is why I had my buddy Vince Lancy write a chapter on de-dollarization. So it's important that people know that it's not my area of expertise. But I think one thing that's interesting, I did put a chart in the first chapter where if you look at the percent of, I think it's a percent of foreign reserves that are in gold. I know, I think the person who puts it, I think he's Jan Gold on Twitter, like JAN Gold. I think that might be his handle. So I can't pronounce his last name. It's pretty long.
Yeah.
Yeah. But no, yeah, he just puts out this really great chart where you can see the percentage of foreign central bank or foreign central bank holdings, what percent of their reserves are in gold. And if you look at how high this was in the 70s, I don't have the numbers handy, but from the 70s until 2 or 3 years ago, it came way down, like just from a high percent all the way to a low percent. And now it's just started to move up. So there's a huge amount of room, like what we've seen governments do in foreign central banks and sovereign wealth funds, what they've started to do in the last couple of years, that has to continue. And better said, it has a huge amount of room to continue because they have to keep buying gold to get back to where they were in the 1970s, the level of their reserves that are in gold. I mean, what else would you want to own? You have a secular bear market now in U.S. bonds. I mean, what else? There's uncertainty with the European Union and all that. And there's no better answer for them. And obviously, the U.S. Deciding to basically confiscate the Russian reserves in the wake of their invasion for Ukraine. I mean, that was a big issue. And we're kind of seeing, I guess, geopolitically, again, totally not my expertise, but people say we're going from a unipolar to a multipolar world. And, it's not unipolar. So, again, that money has to come out of U.S. financial assets. And, gold is by far the best answer. And so, again, not de-dollarization, not my level of expertise. But I would say a couple things that are interesting. You go back to before 1971, where France and other countries, they saw the inflation that was happening, all the huge deficits we were running, the government spending. They they were turning in their dollars because they wanted to get gold. You could say that kind of precipitated the start of that secular bull market. And in the last few years, I mean, you could say similarly, the central bank buying that has, and again, foreign governments, sovereign wealth funds, central banks, dumping their treasuries for gold, you could say, well, that's precipitated. I mean, history will tell us, but I think in a decade, you could say, yeah, history, I mean, it kind of repeated itself the way it did at the end of the 1960s. So that's interesting. But I'll just conclude by saying the chart in chapter 1 of my book, it's towards the end. That to me is what you need to understand about de-dollarization. Like people smarter than me will tell you what's going on. But when you look at that chart and see how much room they have to continue to add gold, that's why they're going to, that demand is going to stay at current levels or maybe even increase at some point.
Back in your wheelhouse, you talk about in your book why historical market trends reveal what we need to know about the next 15 years for gold and silver. You've mentioned several things here about the next 10 years plus for gold and silver. What are you looking forward to?
Well, a secular bull market. I'll step back and say, if you look, I'm not a big cycles guy, but it's really interesting how if you look at long-term inflation cycles and cycles of commodity prices, they tend to peak every 30 years. And there's a massive peak, like a real significant peak every 60 years. And so if you look at the 30-year peaks going back to, 1920, after a pandemic, you had that peak. 1951 was a peak in commodity prices. 1980, a very significant peak. 2011. And so 2040 is shaping up to be a real significant peak based on that 60-year cycle. You go back to the Civil War, there was a peak in commodity prices in, 1863, 1864. You had that peak, you had 1920, then you had 1980. So it's setting us up for 2040 or around that point. So the inflation cycle and commodity cycle that we're in, it's just getting started. So I think, for people who are investing in hard assets, gold, silver, energy stocks, I mean, you're going to have this historical bull market, this historical secular bull market that I think for commodity prices in other commodities, like that can last towards 2040, whereas gold's a little different, because if we have some huge blow off in gold, before 2040, that could be it. The government might have to reinstitute some kind of a gold standard or something like that. So that's why in the book, at the end, when I make predictions, I'm a little conflicted. Like, do we have another 10 years left in gold, or do we have another 15 years? So I'm not really sure, but stepping back, I think the cycle of inflation and other commodity prices, I think that can definitely run towards the end of the decade. And, unfortunately, it's not going to be good for society and most people. So I'm really worried about that. And I'm not someone who was worried about it before, but it's just natural to see where the price of gold and silver and other commodities could go. And they're going to go much higher if you look at the math. Look at our monetary base, and historically, the amount of gold that we have, or that we had, the gold price, based on the gold we had, the gold price hit a percent where the gold that we had would have backed 100% or more than 100% of the monetary base. So that happened in the 1930s and 1980. And at the same time, if you look at gold against the stock market, gold against the S&P, that peaked in 1980, I think like 7x or 8x. And there's been other peaks in the last 125 or 150 years that have been around 4x, 5x. I mean, the S&P, I haven't checked it, because I mostly follow precious metals, or I don't look at what is it, 5,500 or something like close to, just take 6,000 times 4. That puts you at like basically 25,000 for a future price of gold. And for silver, we know, again, you look at the last 125 years, there's like 3 or 4 times where the gold silver ratio has come down to 15, 16x. So that's, we have a future where a silver is going to 4 digits. I mean, gold is easily going to 5 digits. So that's what we're going to see in the next decade. Clearly right now we're in a cyclical bull market. I don't know, maybe it runs for 2, 3, 4 more years, maybe even 5 more years. And then you get a cyclical bear market where, gold could go down 30 or 40% again. Silver could go down 60%, because that's the nature of a bear during, a cyclical bull in precious metals. Now, I mean, that sounds really nasty or terrible, but that would be coming from much, much higher levels. For the cyclical bull for gold, I mean, this may not peak until it gets to your 7,000, 8,000, something like that in the next 3 to 5 years. Like this could be the first run. Then you have a bear market, and then you kind of have the next wave into the 2030s. And I think for this cyclical bull, I think silver will reach 100 and go above it. So we are, we're in the early stages of a cyclical bull, a really, really significant one. And yeah, I think it could run for another 3 or 4 years or so. But yeah, that's what people have to look forward to. And there, of course, will be a lot of volatility along the way. And those price targets I mentioned for gold and silver, the important point I should also mention, it doesn't mean gold and silver will stay at those prices. I mean, if gold's going to peak at 30 or 50,000, and we're not back on a gold standard after that, the eventual crash, it'll come back, 50% or 70% or whatever. But that's from, really, really high levels.
Yeah, we're sensitive on this channel on Liberty and Finance about the plight, as you mentioned, to ordinary people and the tough times ahead. This channel was started back in 2013. I found that it was originally called Reluctant Preppers, talking about preparation for anything that could disrupt your family's well-being and thriving, and including natural disasters, et cetera, et cetera. But financial concerns emerged as by far the most prevalent among our subscribers and among our audience in the questions that they submitted for our guests. And that's just naturally and organically grown the direction of the discussion here at Liberty and Finance. And it necessitated the name change a few years back to Liberty and Finance, talking about both freedom and financial thriving that helps to facilitate freedom for people's lives, ordinary people. And grateful for your presence here. We've been speaking with Jordan Roy-Byrne. He's a chartered market technician, master financial technical analyst, and he is the author of the book, 2025 book. It's called Gold and Silver, The Greatest Bull Market Has Begun. Jordan, before we let you go, just tell our audience where they can get a hold of your book.
At thedailygold.com or thedailygold.com/book. And they sign up for my free newsletter there, and I'll give them my book for free. They get a free PDF file and also a free EPUB file, which you can read on your device, and it looks like you're reading a physical book.
Excellent. Okay, great. Well, thank you guys. Don't hesitate to take advantage of that offer. It'll be in the description of this video. Jordan, thanks again.
Thank you so much for having me.
This is Kaiser Johnson with Liberty and Finance. With premiums on US 90% silver constitutional coinage at multi-year lows, this may be an ideal time to swap silver bars or rounds for 90% silver and gain all the benefits of US Mint lineage, legal tender status, non-reportability, and fractional utility. So right now we're running a special where we will swap any of your silver bars or rounds for 90% constitutional silver at a minimal premium difference. Call us for details.